Naturally, steeper portions of a downtrend will more commonly take place when the balance of power indicator remains under zero. This will also usually be for a short duration that is best used when a clear resistance area is marked. These characteristics are especially apparent when there's a steady drop following a sharp peak. But as we know, balance of power frequently changes. In this case, extra attention is paid to whether price can get back over the previous high range from the highest price and highest closing price. Since previous highs are not being surpassed and the indicator is going back to negative territory, a substantial drop lower is more likely once price gets under the mid-44 range of support defined by the most recent upswing point, and can be sustained to some degree as long as balance of power values remain under zero. But once the indicator returns back over zero, even for a short time and with relatively low values, the downtrend can pause or slow down as price becomes more range-bound, with no significant sustained balance of power for either the bearish or bullish side. Then when there's a continuation lower, the steepest portion of the next drop will likely take place when the lower boundary of this flat area is broken through, and balance of power stays under zero for a short time. Just like with the short-term bullish reversal context we saw earlier in the previous video, candles that overlap a price range can also be considered a kind of bearish reversal formation. Then once price goes below the lowest area of this range and balance of power stays under zero, it's likely to be one of the steepest portions of the new downtrend, which will realistically last for a short time since balance of power quickly changes, and once there's at least one bar over zero, neutral to even bullish movement becomes more likely, and can lead to a significant stall of the downtrend or even eventually a complete reversal.